At Insightful Value, we like to fish where others aren't looking, and sometimes that means heading into colder waters. Today, we're talking about SalMar, one of the world's largest salmon farmers, whose stock has been hit hard lately, even though the fundamentals are still swimming along. This review is for informational and educational purposes only. It is not financial advice. SalMar is a Norwegian aquaculture company focused on farming, processing, and selling Atlantic salmon. They operate traditional sea-based farms along the Norwegian coast and have been pushing the boundaries with innovative offshore farming through their ocean farm and smart fish farm projects. In other words, this isn't your average fish story. It's high-tech seafood production on a global scale. So, why is the stock so low? Several reasons. First, the entire Norwegian salmon sector got rocked by the government's controversial resource rent tax on aquaculture profits. This added regulatory pressure spooked investors and hit earnings. Second, export costs and feed inflation have added to margin compression. And third, general market risk-off sentiment has driven valuations lower across European equities, especially in niche industries like seafood. But let's zoom in. Despite these challenges, SalMar remains a major global player with solid operations, vertical integration, and a strong export base. Their 2024 financials show some revenue pressure due to volume and pricing issues, but the company still posted healthy operating margins. Profit margins have narrowed compared to peak years, but efficiency gains and solid biological performance have helped cushion the downside. SalMar also pays a dividend, and it's not token. Over the past few years, the dividend has been stable and meaningful. Even in 2023, after a tough year, the company maintained a respectable payout. Management has been disciplined in capital allocation and continues to invest in innovation, particularly offshore farming, which could become a real differentiator long term. From a value perspective, the stock is trading at levels that imply prolonged weakness, but the core business is far from broken. The company has low financial leverage, a globally recognized brand, and a product with growing long-term demand. Seafood, especially salmon, is increasingly viewed as a healthier and more sustainable protein, and SalMar is positioned to meet that demand at scale. Now, let's talk risks. Regulatory uncertainty remains the biggest wildcard. If Norway tightens taxation or limits production growth, SalMar's profitability could take a long-term hit. Input costs, especially feed, remain volatile. There are also biological risks, including disease outbreaks and sea lice, which can impact yield and operating costs. Finally, global trade friction or weakening demand from key markets like the EU and Asia could weigh on pricing. So why look at SalMar right now? If you believe the tax impact is already priced in, and that long-term seafood demand remains strong, this could be a classic overreaction setup. The business is real, the product is essential, and the company is adapting to headwinds with innovation. Why stay away? If you expect more political hurdles or see global food prices staying elevated, margins might stay suppressed and the stock might remain underwater for longer. At Insightful Value, we break down companies like SalMar with clear, data-driven insight. No fluff, just facts that help you think more clearly about real-world businesses. Whether you're just starting out or already deep in the investing game, we give you tools to make better calls. You can find more on SalMar and similar under-the-radar companies at insightfulvalue.com. Don't forget to like the video, subscribe to the channel, and head over to insightfulvalue.com for deeper analysis.